I'm aggressively buying Bitcoin in this sell-off. A much bigger and scarier crash is coming, Raoul Pal warning.
Where we are now is the liquidity cycle has now met the bottom of the exponential trend, the adoption trend, and that becomes an extremely interesting time to focus on accumulating crypto. What also happens at the bottom of liquidity cycles is things blow up. Less money around means those worst borrowers and people who have abused capital tend to blow up. And we saw that starting in June in the crypto markets as the centralized finance part, the CeFi part of crypto blew up as credit became less available, and you start seeing who's swimming naked when the tide goes out. And there was a whole bunch of people swimming naked. What we didn't realize is there was a naked whale, and the naked whale was FTX and Alameda.
Hello, welcome to our channel. Today's video, Vision CEO Raoul Pal shares his perspective on FTX failure and its long-term effects on the crypto markets, particularly Bitcoin, along with an explanation of the current sentiment in the markets. Raoul also talks about Bitcoin's exponential growth and widespread adoption. Make sure to stick around to the end of this video where Raoul Pal shares his views on Bitcoin bottom and next bull run. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
FTX Alameda failure is on everybody's mind. The contagion does not seem to be contained. What other failures and market adjustments could we expect? How much longer could this take to play out? I have a slightly variant view, but you can't have much confidence. I think most of the bad leverage was taken out in June, and this was the final part that should have happened in June but didn't. So what are the knock-on effects? Well, normally if Alameda had gone bust, the knock-on effects would have been Celsius and BlockFi, etc. They already went bust. So we've got the knock-on effects of FTX having bought them and then can't fund them. But I think that was a kind of known failure. So is there somebody bigger here that is yet to get knocked on? Some people have looked at the banks like Silvergate. It's possible. I don't think that it's systemic for the banks in that respect, the crypto banks. Signature, Silvergate, those two are the main lenders in the system. What I do know is there's a lot of hedge funds trapped in FTX because FTX was really the avenue for the ability to short markets via the perpetuals. So a lot of hedge funds use them and they've got that assets trapped, which is a shitty situation for everybody involved. And I don't know how that resolves. I got caught out in MF Global myself. It was very similar. It took a while before we got our money back, but we got a big first tranche back. And then eventually over time, as the administrators and liquidators sorted it out, we got the rest back, but that took years. So that's one of the reasons I think the markets have been less aggressively pricing the downside. It's difficult to short the markets. A lot of the hedge funds won't use Binance, for example, because they can't get it through compliance. And a lot of the other products aren't available on the other exchanges. So it's kind of muted the market, which is why it's been so quiet. But there could be other shoes to drop. I don't know really who they are or what they are. People have been looking at Genesis, Jump, and the other market making firms. Is it possible? Well, they've all said no, but as we know, that means nothing in this world because everybody says, no, we're all fine. We're just going to have to wait and see. But I am biased towards if there is another sell-off, you want to start aggressively adding into it because the macro cycle is turning. And I think this is the final phase, the capitulation phase. And
at the moment, we are smack dab in the middle of a financial panic and an epidemic that has spread over other industries. Despite the fact that FTX and Alameda have dropped, a significant number of other companies in the cryptocurrency industry, including funds, market makers, exchanges, miners, and other enterprises, will follow suit. This is a blueprint that is very similar to what we saw in the previous crash that was ignited by Luna. The only difference is that the one will have a greater impact on the market. The misallocation of capital, undue leverage, and speculation that comes with the tide of global economic liquidity receding are being properly cleansed and washed away by this process. In light of this, everyone is eager to seize the opportunity presented by the next domino to fall. It's to be expected. While the majority of the information regarding balance sheets and the system's hidden leverage is unknown, new information and developments in real time appear to be flooding out every half hour. The market's closely monitoring the activities of exchanges at the moment, paying attention to their every move and transaction. There's a good chance that no other exchange will behave as irresponsibly with customer funds as FTX and Alameda did. But we do not yet know which exchanges are resilient enough to weather a bank run.
I've been around this market since 2013, and I've been through all of these and I've seen all of them, and the sentiment is as shitty as I've ever seen it, for obvious reasons. A lot of people have lost a lot of money being caught in all of these kind of fake crypto, which is, they're centralized, they're opaque, they lend your money out in ways that you don't understand to give you a yield which you're grateful for until you realize that you've had open-ended risk on the back of it, which is one of the reasons I've said, please don't don't use yield. Staking yield is fine as long as you understand that your risk is the currency that you're staking in, which is Ethereum or Solana or whatever it is. That moves up and down. You're going to make or lose money according to that. But the yield is relatively safe because it's written into a smart contract. Yield otherwise, I don't like. I don't take it. I don't use it. Same with leverage. I don't like leverage. If you're going to use leverage, and people will come to me and say, well, you said you were leveraged long in Ethereum. I used call options that had 5% of my capital at risk, and I got a wrong bet, and I lost that 5% in the call options. Totally defined risk. So it's defined risk taking, and options are great for leverage like that. They're not easily available in crypto. Foreigners can use things like Deribit. Now, LedgerX, which was the US version, is all tied up in this bloody Sam Bankman-Fried mess. So I don't even know how that's going to work. And that's another issue for the hedge fund market. There's no option market unless you can trade offshore. So it's really complicated out there. But let's wait and see. But don't use leverage. If you do, use call options, but you still have a risk the exchange goes under and you might not get paid back even if you win. So just be careful with this stuff. Don't risk your life on it. And don't use yield unless it's staking yield and you understand you're taking the risk in the underlying protocol. So let's see how much longer it takes to play out. The answer is I don't know. Market could have rallied today, didn't. So, maybe we've got the other leg lower. I think people want lower. I think there's a lot less buyers around right now, again, because a lot of hedge funds have got their positions trapped. I run an asset management business that invests in hedge funds. We had one that got trapped. A few have had some of their balances trapped on FTX. So it doesn't look as systemic as I feared, but I don't know yet. So, but again, it's not that the hedge funds are going to go bust. It's just their capital gets frozen. So it's a bit weird.
The March 2020 COVID crash, the Luna crash, and now the FTX and Alameda crash have all been comparable in terms of the trend of Bitcoin fleeing exchanges. This trend has been consistent during the three most recent major market panic episodes. Bitcoin is quickly disappearing from exchanges as the migration of exchange and counterparty risk becomes the top goal. Almost the course of the past month, exchanges have seen a net outflow of over 122,000 Bitcoin, which is a trend that should be applauded. The most recent decline can be attributed to a lack of openness, trust, and restraint in centralized institutions, which allowed for a disproportionate leverage. The best defense against the risk of the future is to keep a larger portion of the Bitcoin supply in one's own private custody. Having said that, it's a broad and unlikely assumption to believe that all these Bitcoins will be placed in private storage with the intention of never being sold on an open market again. It's highly likely that players in the market are taking every precaution they can, regardless of whether their intention is to keep this Bitcoin for the long term or to send it back to an exchange at some point in the future.
Crypto is driven by two things. The technology, which is Metcalfe's law, the adoption of that technology and its uses, which is Metcalfe's law, to remind you, is the number of connections on the network and the number of people on the network and the number of connections. So how much network activity is there amongst how many people? So that is Metcalfe's law. That's the technological driver that drives the exponential growth. In the middle, you have cycles. The cycles are driven by liquidity, same as all assets. And liquidity being drawn out as M2 shrinks, the Fed raise rates, other central bank raise rates, means that crypto falls. As liquidity flattens out and starts turning up, then crypto rises, as do other risk assets. So that's the basic cycle.
A widespread feeling of mistrust in counterparties and self-sovereign practices are likely to increase among buyers of Bitcoin going forward as a result of the industry's largest ever exchange collapse. This can be viewed as the industry's only silver lining. Although numerous individuals have been emphasizing the significance of personal custody for the world's first decentralized digital bearer asset for more than a decade, their arguments have frequently been met with indifference because financial institutions such as FTX appeared to be reliable and credible. That can be unquestionably be affected by fraud. Users are fleeing to personal custody as a result of this dynamic and the potential for greater amounts of contagion among the crypto space. As a result, the most recent week brought in the largest week-over-week decline in Bitcoin on exchanges, which was 115,200 Bitcoin. So do you think Bitcoin's regulation will drive its adoption? Tell us in the comments. Also, don't forget to like and subscribe. We'll see you soon with the next video, and thank you so much for watching.